The markets are about to close for the weekend, and what I'm seeing right now should concern every American with retirement savings. While most people are focused on their weekend plans, something extraordinary is unfolding in the precious metals markets that demands your immediate attention. Let me be direct with you. The gold market is showing technical patterns that we haven't seen since the early stages of previous major bull runs. We're talking about the kind of setup that preceded massive wealth transfers in the past. And here's what makes this weekend different from every other weekend this year. The institutional positioning data that just came out is showing something that frankly shocked even seasoned market analysts. You see, when markets close on Friday and reopen on Monday, anything can happen over that 48-hour window. Geopolitical events, central bank announcements, currency crises. And right now, we're sitting at a critical inflection point where the technical setup, the fundamental drivers, and the institutional behavior are all converging in a way that suggests we could see significant moves when trading resumes. Let me walk you through exactly what's happening, because this isn't about fear-mongering or hype. This is about understanding the mechanics of what's unfolding in real time and why the smart money is positioning themselves right now before the weekend gap potentially changes everything. First, let's talk about what gold is actually doing at a technical level. We've been consolidating in a range that's acting like a coiled spring. Every time gold tests the upper boundary of this range, we see massive paper selling come in to cap the price. But here's the thing that's different now. Each successive test of that resistance is requiring less and less selling pressure to push it back down. That's not a sign of strength in the resistance. That's a sign of exhaustion. The commercial traders on the COMEX, the big banks and institutions that typically short gold to hedge their physical positions, have been reducing their short positions at a rate we haven't seen in years. When these players start covering shorts aggressively, it's usually because they see something coming that makes holding those positions too risky. They're not doing this because they suddenly love gold. They're doing it because their risk management models are flashing warning signals. Now, before I go further, I want to make sure you have access to something valuable. I've put together a free guide in the description below that breaks down the wealth protection strategies that thousands of American retirees are using right now. It's completely free, and it could be the most important thing you read this month. Check the description after this video. Back to what's happening in the markets. Silver is telling an even more compelling story. The gold to silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has been compressing. Historically, when this ratio tightens, it's been a precursor to explosive moves in both metals, but especially in silver. Silver has this unique characteristic where it's both a monetary metal and an industrial metal, which means it gets squeezed from both sides when demand picks up. And demand is picking up in ways that most people aren't paying attention to. The solar panel industry alone is consuming silver at rates that are straining available supply. Electric vehicles use significantly more silver than traditional cars. 5G infrastructure build-out requires massive amounts of silver. These aren't speculative future demands. These are current, ongoing industrial needs that are pulling physical metal out of available stockpiles. But here's where it gets really interesting. The COMEX warehouse stocks, the actual physical metal sitting in registered vaults available for delivery, have been declining steadily. At the same time, we're seeing an increase in delivery notices. That means more people are standing for physical delivery instead of rolling their contracts forward or settling in cash. When you see this divergence, when available supply is dropping while demand for physical delivery is rising, you're looking at the setup for a squeeze. Let me tell you a story that illustrates why this matters. Back in the late 70s, there was a period where the Hunt brothers tried to corner the silver market. Now, I'm not suggesting anything like that is happening now, but what that episode taught us is what happens when physical demand overwhelms paper supply. Silver went from single digits to nearly $50 an ounce in a matter of months. The mechanics of that move weren't just about the Hunt brothers buying. It was about the realization that there wasn't enough physical metal to satisfy all the paper claims. Fast forward to today, and we have a situation where the paper-to-physical ratio in precious metals is estimated to be somewhere between 100 to 1 and 250 to 1, depending on who you ask. That means for every ounce of physical gold or silver that actually exists in vaults, there are potentially hundreds of paper claims on that same ounce. As long as everyone's happy holding paper, the system works fine. But the moment people start demanding physical delivery and size, the whole structure becomes unstable. The central banks understand this better than anyone. That's why we're seeing record gold purchases by central banks around the world. China's been accumulating, Russia's been accumulating, India, Turkey, Poland, Hungary, the list goes on. These aren't small purchases either. We're talking about hundreds of tons of gold being moved from Western vaults to Eastern vaults. And they're not doing this because they think gold is going to go up 10 or 20%. They're doing this because they're preparing for a fundamental restructuring of the global monetary system. Think about what that means for a moment. Central banks, the institutions that literally create money out of thin air, are choosing to exchange that money for physical gold. They could buy anything. They could buy stocks, bonds, real estate, art, anything. But they're choosing gold. And they're doing it quietly, consistently, month after month, regardless of the price. Now, the mainstream financial media will tell you that gold doesn't pay interest, that it's a barbarous relic, that you should be in stocks or bonds or whatever the flavor of the month is. But here's what they're not telling you. The real return on gold isn't measured in dollars. It's measured in purchasing power preservation. When currencies lose value, when governments print money to solve their debt problems, when the financial system gets unstable, gold maintains its purchasing power. It has for thousands of years, and it will continue to do so. Let's talk about what's happening with the dollar, because this is crucial to understanding where gold is headed. The dollar index, which measures the dollar against a basket of other currencies, has been showing signs of weakness despite the Federal Reserve's attempts to maintain its strength through interest rate policy. But here's the thing about the dollar that most people don't understand. The dollar's strength isn't just about interest rates. It's about confidence. It's about the world's willingness to hold dollars as a reserve currency, and that confidence is eroding. The BRICS nations, Brazil, Russia, India, China, and South Africa, have been openly discussing alternatives to dollar-based trade. They're setting up currency swap agreements. They're trading oil in yuan. They're creating alternative payment systems that bypass the dollar entirely. This isn't conspiracy theory stuff. These are official government policies being implemented right now. When you combine this de-dollarization trend with the massive debt levels in the United States, you start to see why gold is becoming increasingly attractive. The U.S. national debt is now at levels that would have been unthinkable just a decade ago. The interest payments on that debt are consuming an ever larger portion of the federal budget, and the only way out, historically, when governments get into this kind of debt trap, is to inflate their way out. That means printing more money, which means each dollar becomes worth less, which means gold becomes worth more in dollar terms. But it's not just about the dollar. The euro has its own problems. The yen has been in a managed decline for years. The pound sterling isn't what it used to be. When you look around the world at major currencies, they're all being debased simultaneously. It's a race to the bottom, and gold is the finish line. Now, I want to address something that's particularly relevant if you're sitting on retirement savings. The traditional 60-40 portfolio, 60% stocks, 40% bonds, that financial advisors have been recommending for decades is facing challenges it's never faced before. When both stocks and bonds can go down at the same time, which we've seen happen recently, where's the safety? Where's the diversification? This is where physical precious metals come into play as a portfolio insurance policy. I'm not talking about putting everything into gold and silver. I'm talking about a strategic allocation that provides protection when other assets are under pressure. Think of it like fire insurance on your house. You don't buy fire insurance because you think your house is going to burn down. You buy it because if it does, you want to be protected. Quick aside here, and this is important if you're in this situation. If you're sitting on $100,000 or more in retirement accounts, I've put together a comprehensive guide on how gold IRAs work. It's in the description below. It covers how you can get physical gold into your retirement account without triggering tax penalties, how the process works, what the costs are, all of it. It's worth checking out if you're thinking about adding precious metals to your retirement strategy. Now, let me get back to why this particular weekend matters. The technical setup I mentioned earlier, the consolidation pattern we're seeing in gold, is sitting right at a level that's been tested multiple times. Each test weakens the resistance. It's like a dam with water building up behind it. Eventually, something gives, And when it does, the move can be explosive. We've seen this pattern before. In 2008, gold was consolidating in a range while the financial crisis was building. Most people didn't see it coming. But gold saw it. Gold started breaking out before the crisis became obvious to everyone else. By the time Lehman Brothers collapsed, gold had already made a significant move. The people who positioned themselves during the consolidation phase, before the breakout, those were the people who protected their wealth. In 2011, we saw another major move in gold. That was driven by the European debt crisis and concerns about the stability of the euro. Again, gold moved before the crisis became front-page news. The pattern is always the same. Gold sniffs out trouble before it becomes obvious. And right now, gold is telling us something. The silver market is even more interesting because of its smaller size and its industrial demand component. When silver moves, it tends to move faster and further than gold on a percentage basis. That's because the silver market is much smaller, so it takes less capital to move the price. But it also means silver is more volatile. You can see bigger gains, but you can also see bigger pullbacks. That's why many investors use gold as their core precious metals holding and silver as a more aggressive, opportunistic position. Let me tell you about what happened in 2020. When the pandemic hit and governments around the world started printing money like there was no tomorrow, gold and silver both had significant runs. But here's what's interesting. The move didn't happen immediately. There was a period where precious metals actually sold off as people scrambled for cash. But then, once the money printing became obvious, once people realized that trillions of dollars were being created out of thin air, that's when gold and silver took off. We're in a similar situation now, but with some key differences. The money printing that happened during the pandemic never really stopped. It just became less visible. Government spending is still at elevated levels. Central banks are still managing their balance sheets in ways that amount to ongoing monetary stimulus. And now we're seeing the consequences of all that money creation showing up in persistent inflation. The official inflation numbers, the CPI that gets reported every month. Those numbers are calculated using a methodology that understates real inflation. If you calculated inflation the way it was calculated in the 1980s, the numbers would be significantly higher. But even using the official numbers, we're seeing inflation that's well above the Federal Reserve's target. And here's the thing about inflation. Once it gets embedded in the system, it's very difficult to get rid of without causing a recession. So the Federal Reserve is stuck. If they raise interest rates high enough to truly kill inflation, they risk crashing the economy and the stock market. If they don't raise rates enough, inflation persists and erodes the value of the dollar. Either way, gold wins. In the first scenario, gold wins because people flee to safety during economic turmoil. In the second scenario, gold wins because it's a hedge against currency debasement. This is what I mean when I say we're at an inflection point. The choices available to policymakers are narrowing, the room for error is shrinking, and the consequences of getting it wrong are becoming more severe. Smart investors are recognizing this and positioning themselves accordingly. Now, let's talk about the supply side of the equation, because this is where things get really interesting. Gold mining production has been essentially flat for years. Despite higher prices, despite improved technology, despite massive investment in exploration, we're not finding new gold deposits at the rate we used to. The easy gold has been found. What's left is deeper, lower grade, more expensive to extract. Silver has a similar problem, but with an added twist. Most silver production comes as a byproduct of mining other metals like copper, lead, and zinc. That means silver supply is dependent on the economics of those other metals. If copper prices are low, copper mines shut down, and silver production drops even though silver prices might be high. This creates a supply dynamic that's difficult to predict and even more difficult to control. On the demand side, we've already talked about industrial demand for silver. But there's also investment demand to consider. ETFs, exchange-traded funds that hold physical gold and silver, have been seeing inflows. When money flows into these ETFs, they have to go out and buy physical metal to back the shares they're issuing. That creates real demand in the physical market. But here's where it gets tricky. Not all ETFs are created equal. Some ETFs hold physical metal in allocated form, meaning specific bars are assigned to the fund. Other ETFs hold unallocated metal, meaning they have a claim on metal in a vault but not specific bars. And some ETFs don't hold physical metal at all. They use derivatives and futures contracts to track the price. Understanding the difference matters because in a real supply squeeze, the ETFs that hold physical allocated metal are going to perform very differently than the ones that don't. This brings us back to the COMEX and the paper versus physical dynamic. The COMEX is primarily a paper market. Most contracts are settled in cash, not physical delivery, but the price discovery happens on the COMEX. So the paper market is setting the price for the physical market, even though the paper market is much larger than the physical market. This works fine until it doesn't. What would cause it to not work? A loss of confidence in the paper market's ability to deliver physical metal. If enough people simultaneously decided they wanted physical delivery instead of cash settlement, the system would break. We saw a glimpse of this during the pandemic when premiums on physical gold and silver coins and bars spiked well above the spot price. People wanted physical metal, and there wasn't enough retail supply to meet demand, even though the paper price wasn't reflecting that shortage. Imagine that happening on a larger scale. Imagine institutional investors, not just retail buyers, demanding physical delivery. Imagine foreign central banks deciding they want their gold out of New York and London vaults and into their own vaults. These aren't far-fetched scenarios. These are things that have happened or are happening right now. Germany repatriated a significant portion of its gold reserves from New York and Paris over a period of several years. It took years because moving that much gold isn't simple, but the fact that they did it at all tells you something about their confidence in leaving their gold in someone else's vault. Other countries have taken note. If Germany, a close U.S. ally, felt the need to repatriate its gold, what does that say about the level of trust in the system? Now, let's connect all of these threads. We have technical patterns suggesting a breakout is imminent. We have fundamental supply and demand dynamics that favor higher prices. We have institutional positioning that shows smart money reducing short exposure. We have central banks accumulating physical metal. We have geopolitical tensions that are driving de-dollarization. We have monetary policy that's trapped between inflation and recession. And we have a paper market structure that's vulnerable to a physical delivery squeeze. Any one of these factors alone would be bullish for gold and silver, but we have all of them happening simultaneously. That's why this weekend matters. That's why the market close on Friday and the reopen on Monday could be significant. Because if something happens over the weekend, if there's a geopolitical event, if there's a currency crisis, if there's a bank failure, the precious metals market could gap higher when it reopens. And here's the thing about gaps. Once a market gaps higher, it rarely comes back down to fill that gap immediately. The people who were waiting to buy at lower prices suddenly find themselves chasing the market higher. That creates momentum. That creates FOMO, fear of missing out. And that can drive prices much higher than anyone expected. I'm not saying this will definitely happen this weekend. I'm saying the setup is there. The conditions are right. And if you're not positioned, if you're waiting for a better entry point, you might find that the better entry point never comes. Or worse, you might find yourself buying at much higher prices after the move has already happened. This is why preparation matters. This is why understanding what's happening in these markets matters. Because by the time it's obvious to everyone, by the time it's on the front page of every newspaper and the lead story on every news channel, it's too late to position yourself advantageously. The big moves happen before the crowd realizes what's going on. Let me give you a historical parallel that might help put this in perspective. In 1971, President Nixon closed the gold window, ending the convertibility of dollars into gold. That was the end of the Bretton Woods system. At the time, gold was $35 an ounce. By 1980, gold had reached over $800 an ounce. That's more than a 20-fold increase in less than a decade. Now, I'm not predicting a 20-fold increase from current levels. But I am saying that when monetary systems undergo fundamental changes, when the rules of the game shift, precious metals tend to be the beneficiaries. And we're in a period right now where the rules are shifting. The dollar-based system that's been in place since World War II is under stress. The alternatives being proposed and implemented by other countries are real. The debt levels are unsustainable. The money printing is ongoing. These are the conditions that historically have been very favorable for gold and silver. But here's what you need to understand. This isn't about getting rich quick. This isn't about speculation or gambling. This is about wealth preservation. This is about making sure that the money you've worked your entire life to accumulate doesn't lose its purchasing power. This is about having a portion of your wealth in an asset that's been recognized as valuable for thousands of years, across every culture, in every economic system. Gold and silver aren't going to make you wealthy if you're not already wealthy, but they can protect the wealth you have. They can provide insurance against the kind of monetary chaos that destroys savings and retirement accounts. They can give you peace of mind knowing that no matter what happens in the financial markets, no matter what happens with currencies, you have something of real, tangible value. And that's worth more than most people realize until it's too late. I've talked to people who lived through hyperinflation in other countries. I've talked to people who saw their life savings wiped out because they kept everything in their local currency. And the one thing they all say is that they wish they had converted some of their wealth into gold or silver before it was too late. You don't want to be in that position. You don't want to be looking back and wishing you had taken action when you had the chance. Because the opportunity to protect yourself exists right now. The markets are open. You can still buy physical gold and silver. You can still move a portion of your retirement accounts into precious metals. But that window won't stay open forever. When the crisis hits, when the system breaks, when everyone suddenly realizes they need to own gold and silver, that's when premiums spike. That's when availability becomes an issue. That's when you're competing with millions of other people who all had the same realization at the same time. And that's when it becomes difficult and expensive to acquire physical metal. So what should you do? First, educate yourself. Understand what you're buying and why. Don't just take my word for it or anyone else's word for it. Do your own research. Understand the fundamentals. Understand the risks. Understand how precious metals fit into your overall financial strategy. Second, if you decide that precious metals make sense for your situation, start positioning yourself now. Don't wait for the perfect entry point. Don't try to time the market perfectly. Dollar cost average if you need to. Buy a little bit at a time, but start the process. Third, focus on physical metal, not paper proxies. If you're going to own gold and silver, own the real thing. Own coins or bars that you can hold in your hand or that are stored in allocated form in your name. Don't rely on paper promises that might not be honored in a crisis. And fourth, be patient. Precious metals aren't a get-rich-quick scheme. They're a long-term wealth preservation strategy. There will be volatility. There will be pullbacks. But if you understand why you own them, if you understand the role they play in your portfolio, you'll be able to weather those fluctuations without panicking. Now, I mentioned earlier that I have a free guide in the description, but here's something else. If you've watched this far, if you're serious about understanding how to protect your wealth, I'm offering something exclusive. For American retirees with at least $100,000 in retirement accounts, I'm providing access to a one-on-one educational web conference. No obligation, no sales pitch, just education. But you have to mention that you watched this video to the end. The details are in the description below. This is about taking control of your financial future. This is about not being a victim of circumstances beyond your control. This is about making informed decisions based on understanding what's really happening in the world, not what you're being told is happening. The markets close for the weekend, but the forces driving gold and silver higher don't take weekends off. Central banks don't stop accumulating. Geopolitical tensions don't pause. Monetary policy consequences don't wait. And when the markets reopen, you want to be positioned for whatever comes next. I've laid out the case. I've shown you the technical setup, the fundamental drivers, the institutional behavior, the geopolitical context, the historical parallels, and the market structure vulnerabilities. The question now is what you're going to do with this information. Are you going to act, or are you going to wait and hope that everything works out? Because hope isn't a strategy, and waiting has a cost. The weekend is here. The markets are closed. But your opportunity to prepare isn't closed. Take action. Educate yourself. Position yourself. And protect what you've worked so hard to build. because when the next crisis hits, and it will hit, you'll be glad you did.